Thank you very much. Thank you. First, thank you very much for inviting me and for this great forum. I'm honored to be presenting some of my work in academia. And so I'd like to thank, of course, Dr. Shanti. Today I'm going to, so the title I copied Tech for Good, but it's actually Finance for Good. So my talk will be on ethical investing and so environmental, social, and governance and Sharia screening based investing. So first, I want to just start with a quick poll. So you can scan this QR code, and I'll be curious of your answers. It's totally anonymous. You don't have to play. I like actually to do that with my students to see initial, kind of bias, and then check the results later on. So do you currently invest in stocks or funds marketed as ethical or sustainable? It is part of my portfolio. Yes, exclusively. No, but interested. No, not interested. Okay. Okay, so here we have around 60% no, but interested, and then there are people that have that in their portfolio. Oh, so no one is answering the no, not interested. Be honest, I'm just kidding. All right, so let's move to the next question. What matters most in your investment decision? Is it maximum returns, ethical alignments, or risk management? You can choose more than one. Okay, so of course the returns is an important factor. When people say returns, of course people are risk averse, so they need to manage their risk. And of course, you need to kind of, you don't need to, we'll see later on, but if you can align that with your ethics, then it's even better. Okay, so, but maximum returns, of course, is interesting. Would you accept 2 to 3 lower annual returns to invest ethically? So definitely yes, probably no, definitely no. So as a illustration, that's about in an investment of $100,000, that would be, giving up around $50,000 to $65,000 after 20 years. Okay, definitely yes, probably no, definitely no. Okay, so let's actually see, or clear some misconception if there are any, and have some idea of how sustainable investing and Sharia-compliant investing is doing in the market. So my initial research at UC Berkeley was funded by a large insurance company that, of course, has money to invest, and there was that trend in 2018 on sustainable investing. So I was actually pretty convinced that doing good necessarily aligns with the positive returns. So what is sustainable investing? It's an investing that includes environmental, social, and governance, I would say, conditions in the setup of the portfolio. That is, you want to be investing in companies that address climate change or have that climate change mitigation. They clear out any issues of inequality. They have a good employee relations and eventually disclose a fair executive remuneration. So this is known as the ESG investing. So sustainable investing is basically almost, it's the ESG investments. It started in '53, well, at least not branded as ESG. It was like corporate social responsibility in the late or mid '50s. And there are actually a couple of important dates on that, but one of the most important one is the 2004 with the UN Global Impact that coined the term ESG. And the idea is who cares wins. So that's actually the principle in that. So, of course, there were many summaries of ESG that will highlight this moment as kind of the official beginning, although the UN Global Impact kind of started in 2000, but that ESG came up a little bit later. And then came up the principle for responsible investing and so on and so forth. Okay, so how is ESG investing linked to that UN Global Impact? So the idea that 10 principles that are framed in 4 categories: human rights, environment, labor, anti-corruption. They are linked to the 17 Sustainable Development Goals that were established by the UN to reach by 2030. And of course, there are questions like climate action, life on land, decent work, gender equality, and so on. And so ESG is basically rating companies based on how well they are doing in those categories. Of course, there are multiple scoring agencies that take those, so each one might have different scores, but they try to kind of align with principle based on either disclosed information or their own actually research. All right, so this kind of contradicts Friedman doctrine and the shareholder theory, which was actually published in the New York Times in 1970, that established that the whole purpose of a company is to give the shareholders what they're looking for, which is actually basically return. So it aims that businesses maximize the profit, and that's all actually that matters. So corporate social responsibility comes in as in, well, if you actually do well with your employees and your work in general, you'll be able to align with those goals. So how do you actually do that, and what are the current numbers? Currently, there are maybe over $30 trillion invested in ESG companies, or at least that global investment. I think here it includes Europe, Canada, Australia, New Zealand, Japan. I wasn't able to find numbers for Asia, but this is, so that would be actually over that number. And how do you actually include those criteria? Either you do some negative screening, so you exclude stocks, so for example, thin stocks from your portfolio. You do thematic investments, you target specific areas that you are interested in, or you choose best class, so you choose the best companies that in the environment, in the social, and in the governance scores based on whatever rating agency you chose. Okay, so this is for ESG. How is Sharia? I mean, I actually know how to pronounce Sharia, so I don't know why I'm trying to pronounce it Sharia. So Sharia investing is basically something very similar. So its core principles and guidelines come from, teachings of the Prophet ﷺ, and of course the Quran. So basically, ownership materiality. So you want your assets to be linked to, or your finances to be linked to real assets. You want risk sharing, so in the sense that the return on capital, so you share both the profit and loss, and then equity, fairness, and transparency, so prohibition of interest, excessive uncertainty, and forbidden activities like gambling, alcohol, and so on. In fact, this is kind of something that is also addressed by ESG in the sense of, sin stock, or avoiding like sin stocks, which was actually a name that was given to stocks by some scholars in the 2007. All right, the principles for, or at least the history behind actually that, I think the foundations, of course, come back to the 7th century. The first Islamic bank was built or made in Egypt in the 1960s with profit sharing instead of interest. It actually closed because of political reasons. It grows substantially with the total Islamic finance assets to be estimated at $4.5 trillion in 2022, and it is expected to reach over $6 trillion in assets by 2027 by the Morgan Stanley Wealth Management Investing with Impact. All right, so the research question here is, if you restrict your investment universe, so that means you actually exclude some based on whatever ESG or Sharia-compliant screening, the idea is you must sacrifice some returns. I mean, you're not diversifying, you're not actually choosing all the stocks, you're choosing a subset of that, and ultimately you expect that you'd be actually doing better, or at least that's if you are able to construct a portfolio with the right assumptions and so on. Okay, but let's actually see the numbers. So here I built quintiles, so I split actually my ESG universe or Sharia to actually the type of subsets, the best in class, the middle, and so on until the worst. And I was looking at their returns. Okay, so you can see in red numbers, just to illustrate, there are so many numbers, you don't need to go all over those, but the red means that you are actually underperforming with the best in class versus the worst in class. So this is actually the UK, ESG on top, and the Sharia screening on the bottom. Red means that you are underperforming with the best in class. Green means that you are overperforming. You can actually see, and here you can see the time series kind of smoothed with respect to time of the spread between your best in class and low in class. So for ESG social, there is more actually underperformance with the ESG, the social, the Sharia, a little bit less on the governance, which is actually comes back to that corporate social responsibility idea. If you look at Asia, on the other hand, you can see that obviously best in class do better, at least in this data set. Now, here we're actually doing association, okay? So in the sense that here we actually have, in some instances, good ESG and Sharia screening choices are associated with good performance, and sometimes they are not, but this is not the full story in the sense that we're not actually comparing apples to apple, we're actually comparing apples to oranges. Why? Because, well, what if companies that are branded good are large companies that have the resources to kind of blush their disclosure, do all, the screenings and so on, build, buy all the sustainable stuff, build and solar energy for their centers and so on, and the not as good are small companies who actually don't have that, that possibility. All right, so this actually comes to the confounder dilemma. So in these plots, we're looking at how different ESG categories are in terms of market capitalization, return on assets, price-to-book ratio, leverage sectors, which are a subset of the FAMA French factors in finance. And so the idea here is, if you look at the purple, when the purple is actually associated with the best in class, in terms of the size, it is actually the larger one, whereas the red one, which is the low in class, is actually a smaller cap. Okay, so this is a little bit 5 categories, so it's less clear. But we'll actually see more on the Sharia-compliant flag, which are just two subcategories. You can see that the Sharia-compliant one in green have a larger return on asset versus the non-Sharia compliant. On the leverage is actually the opposite. It's the idea of the debt in Sharia compliant screening. Book to price ratio, the green is actually has higher ones, which actually suggests that we're not controlling for those factors when we compare the good performing stocks versus the, or at least, the good stocks versus the not as good, or the leaders in those categories versus the laggers. Okay, so the idea of association versus causation is that what we saw is what happens to my portfolio if I choose good stocks instead of not as good. And so I'm comparing basically apples to oranges, I was saying. But what I really want to know is, what if the good stock I selected was a bad stock instead? So just actually that flag of good ESG performance was flipped to a bad ESG performance. How would actually that stock do? Would it perform as good as it was doing now or not? And this is a common problem in observational studies. So this is known as the ladder of causation, introduced by Judah Pearls in his book, The Book of Why. So we start with association. This is actually what we're seeing, observing, but we want to basically make an intervention in our, so this is usually linked to biostats or medical science. So if we change the intervention from like the treatment to a placebo or to a control. And then we actually see or try to answer the question, what would have happened if I would have changed, from the treatment to the control? So it is a common problem in observational studies, which is actually our case. We cannot simply flip, the stock from a leader to a lagger, but we want to still compare apples to apples and oranges to oranges. So how do we actually do in that case? The answer in causal inference is, and in observational studies, is to match. So there is actually a matching technique that basically tries to remove any effect. Okay, so here the idea is that we have our factor of interest, known as the treatment, T. We have our confounders, market size, book to markets, and so on, and we have our returns. And so basically, we want to remove any association between the factors on our treatment variable. Ideally, in randomized experiments, you actually randomly select people and then assign a treatment or a placebo. So what you actually do, again, in that case, is matching the portfolio. So you want to compare a portfolio of good companies with similar companies that are not. Okay? So here in the methodology, I minimize the distance between those companies based on the factors that you want to mitigate for here, the Fama-French factors. So instead of this, where you can see, a kind of difference in those factors, you want something that is actually closer. Instead of this, we also have like that different market cap. You want something like this. Okay, so there is a kind of balance between the leaders and the laggers in that sense. Okay, so now that we actually did that, we checked back again in the spread between the leaders and laggers on different continents: Africa, Asia, Australia, Europe, UK, and the S&P 500. And we're looking at the social pillar score, Sharia compliance, governance, environmental, and ESG. And we actually see in those results that, in fact, in most cases, we are able to have like a green. So green, that means that the leaders are actually performing better. There is, in some instances, of course, a smaller performance, but at least those results with some high significance suggest that the historical observations had a better performance for leaders in mostly Sharia, governance, environmental, and ESG. So you can check those. Yeah. Okay, so this is about it. I'm also putting here, if you have any questions, or this is, yeah, like questions, please screen, ask those questions, and I'll be happy to answer them in the Discord, or if you want to discuss that later. Thank you, and this is it from me.